Good morning, everyone. Okay. So we are going to get started now. I'm just going to allow for a few more people to enter into the room. Okay. So welcome everybody to our virtual workshop. We have got a fun-packed day for you today. But before we get started, can I please let everybody know that all the cameras and microphones are off. You can ask questions to our presenters by using the question and answer function. If there are any questions that you do have that don't get answered for whatever reason, you can contact me directly. So my name is Sarah Evans, and I am Head of Sales over at TMA. Or you can contact your key account manager, or you can contact our marketing team, and we will make sure that any questions that you have got do get answered. This event is all about you. It's about making sure that we deliver what you need. So, make sure that the communication is there if you have a burning question and you want to get some sort of response from us. And because we are committed to making sure that by the end of this session today, you feel like you've spent a few hours that have been well worth it. Your CPD certificates will be sent out to you on email, and there is a telephone number on there if you have got any technical issues at all. Before we get started, I'd like you to meet our broker support team. These are the people that you call through to on the line there. And they are a fantastic team. They do everything they can to support us and to support you, the broker. But I just wanted to pop the pictures up so that you can actually see who they are. Because you get to speak to myself and the sales team on a regular basis, so you know who we are. But it's nice to put a name to a face as well. Just quickly, I just wanted to bring your attention to our Consumer Duty Hub. Because there's a load of really, really good information on there. And if you haven't visited it yet, I would suggest you do so, because it may support you and give you a bit of guidance. And there's downloadable templates, and there's guidance in terms of consumer duty. There's FCA podcasts on there, really, really useful section of the website. So I'd recommend that, if you need a bit of support, that's the place to visit. And by all means, again, back to the key account team, for anything that is a burning question that you do feel that you might need a little bit of additional help with in terms of consumer duty, you can contact us and we will do everything we can to support you. So I just wanted to talk to you very quickly about our TMA conference, and I would ask you to save the date. So the date is the 9th of November. And we're going to have over 60 lenders and providers all in the one place together, one-stop shop for everything mortgage and protection and compliance support. So I would highly suggest that you come along to this event if you can. It's in the ICC in Birmingham, and all you need to do to register is to pop onto the website and pop your name down. Okay. So without further ado, I'm going to quickly run through the agenda and then allow our specialists to get on with doing what they do best. So to start off with, we've got LV. It says Steve Brown, but it's actually Carl Hurd. And we've been graced with Carl today. And Carl is going to be creating opportunities from consumer duty. So I'm looking forward to hearing that. And then we've got David Patton from Fluent Money. And David's going to be demonstrating how we can grow our business with the help of Fluent partners. Then we've got the brilliant Andy Millard from Tipton and Costley Building Society. And Andy's going to be showing us how to give our clients options. And then we have Zephyr. So we've got Mark from Zephyr, National Sales Manager, who is going to be giving us a market update on Buy-to-Let, as well as a market update in terms of what's new for Zephyr as well. And then last but by no means least, we have got our Sue Ramsdale, and we've also got Roger Holmes as the guest speaker, who will be going through our consumer duty top tips. I will be asking some questions that some of our brokers have put forward. So like I said before, if you have got any questions, get them over to us. If we can answer them, we will do. And if we can't, we'll come back to you after the event. And we're hoping to close around 12:30. So on that note, I'm going to move on to Carl, who's going to be looking at creating opportunities from legislation.
Thanks, Sarah. I've just realised I do have lots of builds in this. I forgot to take them out, so apologies. I'm going to keep you busy with the clicking, so apologies for that one. But yeah, go on, let's go for it and click on first, please. And then on to the next one. So as I said, I'm Carl Hurd from LV. So what we're going to talk about today, as I said, I'm going to touch a bit on consumer duty. There's quite a lot of slides, but we'll click through a lot of these because a lot of it is probably a reminder for you for everything consumer duty at the moment. So consumer duty and the FCA, well, actually, the consumer duty forms part of a 3-year strategy with 3 key themes from the FCA. The first 2, you're completely going to expect that from our regulator, aren't you? Reducing and preventing serious harm, setting and testing higher standards. But actually, the one I want to focus on today, I've had a lifetime working in sales. So if I'm going to talk about regulation, I want to look about how I connect that to sales. And I want to talk today actually a little bit more about that 3rd key theme from the FCA, which is promoting competition and especially positive change. So next one, please, Sarah. So consumer duty, you've probably all seen this graph already, especially if you're a business owner. Consumer duty is about 3 key elements there. It's the consumer principle, the cross-cutting rules, and then what they see are the 4 outcomes of that as well. As you can see from the statement, and I'm sure we all know this from everything that's going on in the press as well, the FCA is investing a huge amount of money into this, just over 5 million. So I think it's fair to say straight away, this isn't just a little tweak on treating customers fairly. This is a big project for the FCA and a big part of our world then from our regulator as we move forward. Next click, please, Sarah. So what I want to touch on first is I want to talk about that first outcome there about design of products and services. Now, I fully appreciate for you, whether you're an advisor or a business owner or both, you're not going to be designing products. That's what we do here at LV and with the other providers. But what you do actually is you do design your service and actually you're responsible for the service that you offer as well. So this forms part of your world as well. So I want to talk a little bit, first of all, about your processes and the service you give to your clients. Next one, please, Sarah. Okay, so this is my terrible analogy of how I've broken down consumer duty. So I'm trying to make it as simple as possible. It works for my brain, at least. So if you think about it, and think about your business, now whether you are an advisor or whether you're a business owner, as I said, or both, if you think about, first of all, a car and a service on a car. So your car gets you from A to B. And it drives you around the local streets and everything else, no problem at all, gets you from A to B. And it's due that big service. But you're putting it off because why spend the money? It gets you from A to B. But if you were looking to take that car on a long journey, then you would get that big service done because you want to make sure it's going to get through that big journey. It's going to get you to that destination, perhaps as efficiently as possible as well. And actually, I want you to think about consumer duty a little bit like that service on a car that perhaps you've been putting off, because do you really need to? What consumer duty is doing is making you look at your business, look at your processes, look at how you deal with your clients. So it's making you get that bonnet up on your car, on your business, on your processes, and do that service. Because actually, if we think about the world we currently live in, and I'm sure many of you listening today will be in the mortgage market, that is a challenge right now on you and your business, Because from a mortgage perspective, currently you are doing more work on your mortgages, whether you've realized it or not yet, and I'm sure many of you have, because of affordability checks and the increases there, because of the fact that rates keep changing regularly, you are committing more time to each mortgage that you're arranging for your clients. It's probably a case as well that you're doing more remortgages and more product transfers, which pay you a lower procreation fee normally. So you're committing more time. A lot of the clients you're speaking to, actually, you're getting a lower fee for anyway. So if you sat down and actually looked at your business, at you as an advisor and how you earn money, you're probably earning less per hour now than you were before when you were writing mortgages, because of the extra work involved, because you're doing more remortgages, because you're doing more product transfers. So whilst you might be seeing more clients now, because the great news is with confusion in the industry, that drives the clients to come and speak to you as advisors because you are the experts. What are you actually earning per hour? And are you earning less per hour? Because again, if we think about that car on that big journey, and Sarah, if you could just click the next bit for me. So if you think about that car on that big journey, what you're actually doing is thinking about your business. And your business, or you as an advisor, and your own personal business plan, you have a trajectory, you have a destination you want to go to. And that could be you've got a big personal financial goal you want to hit. It could be you're heading for retirement. Or it could be as a business owner, you're looking to expand, but you have a destination you're heading for. And is your car, is your business, or is your business plan going to get you there as planned? Because if you're earning less for your mortgages, then is it still on track to get you where you intended to get to? Next slide, please, Sarah. And as I said, simply there, with Consumer Duty, that creating positive change, as I said, put the line in there, lifting the bonnet upon your business, think about how you interact with your clients, what service you offer your clients, how do you position the products that you talk about with your clients, and how can you create that into a positive for yourself? That's what Consumer Duty is doing. It's prompting you to actually look at these things, but let's see how it works for you as advisors and business owners. Next one, please, Sarah. So, and next one again, please. Sorry, I did say there were lots of clicks on this. So the bit I'm going to focus on, I say that's right. So the bit I want to focus on then is let's start seeing about how it can really work for you. Now, one of the cross-cutting rules says there, firms must enable and support retail customers to pursue their financial objectives. Now, I think this is a really key line within Consumer Duty that for you as mortgage and protection advisors will really work for you and really help you to write more business and create more income for your businesses. Next slide, please, Sarah. And next one again. Okay, so I'm not going to ask you to put it in the chat, but I just want you to think for a moment. If I was to say to you and each of you as individuals, what is your financial objective? So in life, what is your financial objective? And this is a great open-ended question for you to ask clients as well. If you click, please, Sarah. Sorry, I've got loads of clicks on this one. Sorry, Sarah. I should have got rid of all of these. First click, go on, do another one, and another one, and another one, and another one. That's it. Right, we'll stop there. So if I was to ask you personally, then, what is your financial objective? Your financial objective in life could be you want to keep paying your mortgage every month to pay off that mortgage. Or it could be that you want to keep paying into a pension so that you can have a really healthy retirement. Or it could be, as that little picture there is, it's about making memories with your family. It's about having that great big holiday every year that you get to create all those memories with your family. Or it could be that you want to get your children to university. Or even, as that hand is at the bottom there, you just want to be financially stable enough that actually you can just support your family, whether that's children, whether that's siblings, whether that's parents into their retirement and maybe later life care. But you just want to be able to help your family out. Ask that same question of your clients, because I think that is a great killer line to ask your question, the question of your clients when you're doing your fact find. What is their financial objective? Because the regulator is telling you as an advisor, then you must enable and support them to pursue that financial objective. So by asking them that question, you're going to draw out what perhaps you could have gone to an assumption on. So if you're arranging a mortgage for somebody, you could have gone for that assumption that their financial objective is just to pay off their mortgage. But actually, maybe it's not. Maybe it's about dependents. Maybe it is more about their pension. Maybe it is more about those holidays. But asking that open-ended question draws out lots of different things that client will tell you about what their financial objectives are. And then you can start talking about protection in order to make sure that those financial objectives can still be pursued. Next slide, please, Sarah. And again, and another one, and one more. That's it. Stop there. Oh, back one. There we are. So again, when you talk to clients about actually how you're going to pursue your financial objectives and what's going to support that, well, income is going to support that, isn't it? You know, it's what comes in through the door is going to pay for all those financial objectives. And actually, we did a survey like end of last year that said to people, actually, if you were off work through sickness or injury and that income wasn't coming in, what would you actually rely on? Now, we've been through this before, and if you've seen me present, you've seen me talk about these before. People think they rely on savings. Let's cut to the chase on that one. If you're doing an affordability calculation or budget planning with your clients, you know what they've got in savings, you know what their outgoings are. Be on the front foot. Address that with your client up front and say to your client, right, we've had a look at your savings, we've had a look at your outgoings, and actually I know they're going to last you 2 months, 1 month, whatever it might be, because nobody has all those wonderful savings they think they do. And our average income protection claim, for instance, is over 5 years. But I would say to you, be on the front foot. When you're talking to somebody about financial objectives, be on the front foot, and let's start bursting bubbles a little bit here. So first of all, point out to them, you've done the calculation, this is how long their savings would last. The next thing is clients may well say to you, well, if I couldn't work and I didn't have an income, it's fine because my employer will bail me out. Again, we know that that is changing more and more. And actually, even in our survey, the clients conflicted themselves because 34% said they're going to rely on their employer's sick pay. And actually 25% said, I don't even know what we're getting. So how are you going to rely on it if you don't even know what it is? So again, be on the front foot, have that conversation with your client, get them to find out what do they actually get from their employer. And actually, I think this is a really interesting one. And again, when you're looking at your processes, your service you provide your clients, those questions you ask your clients, I think this is a great opportunity now coming up again, where you can offer an open-ended question for your clients. Because 75% of the people we spoke to said they had at least one other person dependent on their income. Now, how many of you perhaps, when you are talking to clients, think about dependence in respect of smaller children? And if they haven't got small children, you almost have a bit of a blinkered eye to that one and forget that actually they may have other dependents. So why not change your question? Change your question to, who else is dependent upon your income? And see what comes out. Because that other person dependent on their income may not be younger children, it could be older children. As I said, people through university or whatever it might be. It could actually be parents. Again, they're helping support later life care. It might even be they tell you that that person or that person, if you like, are dependent on their income is actually their dog, because the bills and everything else that come in to pay for that pet, they need their income to support that. So there's lots of different ways that a client can tell you that something or someone is dependent upon their income. So again, add that as an open-ended question. Next one, please, Sarah. And I'll quickly on this one, we'll do another click as well. That income supports all of those outgoings. The moment income is taken away, everything falls. So again, if we think about those financial objectives, we think about those dependents, income is supporting the whole lot. Next one, please, Sarah. So quick blatant plug from LV. They pay my wages, so I really should. If you are talking to your clients about protecting income and you want to look at income protection policies, we have a raft of experience in this. And we have 2 products specifically. We have full and budget income protection, and then we have full and budget personal sick pay. Both income protection style products. The income protection is a bit more traditional. The personal sick pay gears a little bit more towards manual workers and self-employed. But if you wanted to know more about what we offer on income protection, then we have lots of tools, which I'm just going to touch on one in a minute, that's available on our website. We do a series of webinars like this one today, where you can log on and watch us do different presentations. So if you want to delve into products a bit deeper, you can join one of those. And it'll be somebody much more technical than me. Or please do use and talk to your account managers. Consumer Duty is a big, big, big thing going through all your businesses. And the more we can support you, the more we'll try to. Next one, please, Sarah. And next one again. So let's just touch on, and again, we're cantering through a bit today because of time, but a little bit of the outcomes now I want to focus on is consumer understanding and consumer support. Next one, please, Sarah. So if you've seen me present, you know where I'm going with this one. We talked about it before you all joined this morning. I am passionate about this. I think it's an amazing tool for you to position protection with your clients. So when thumbs up from Sarah, because the conversation we were having earlier on. So again, if you want to gain consumer understanding and positioning of protection with your clients, look at using a risk calculator. I'm going to tell you to use LVs. I'm going to tell you to use LVs for two reasons. One, again, they pay my wages. But the other one is I actually worked on this calculator when we created it over 10 years ago, and it still remains the only one that is completely client facing. So you don't have to go into any sort of product solution mode at all. When you are positioning it with your client, you can do this when you're setting your stall out for what you're going to do as far as the mortgage journey. You could say to the clients, one of the things we're going to be talking about was we're going to be talking about protection at some point along this mortgage journey. And then what you do, or you send your client to the website, you put in some basic details here for Mr. and Mrs. Smith, both 35, both looking at a 30-year term. It says retirement age, but you can put that to mortgage term end if we wanted to. You've got the gender, male and female, and Mr. Smith does like a smoke day. He's a smoker. And if you click on the next button, please, Sarah, we calculate the risk. Sorry, Sarah, click again for me, thank you, and another one as well. And then what it does, it gives us those full percentages. And if you are positioning protection with your clients, these are great numbers to be discussing with your client. And remember, they can go onto this website, they can create these themselves. Mrs. Smith can berate Mr. Smith over the fact he smokes. And when she changed into a non-smoker, she realized their percentages got a lot better. But the first one to dwell on is 66%. So for Mr. and Mrs. Smith, 35-year-olds with 30-year term, there is a staggering 66% chance that they're going to need to rely on a protection policy. Now, the great thing on this as well, when you were talking about consumer understanding, so many of your clients, as you know, will assume that when you talk about protecting a mortgage, especially, they think about life insurance. And they realize that if they went online, they could perhaps get it cheaper than you're talking to them about it. So they could go online and find out that life insurance is cheaper through the Opera Singer or the Meerkat. But what you get able to do is you're able then to say to them, great, yeah, you're right. Life insurance is cheap. And the reason it's cheap is for you, Mr. and Mrs. Smith, it is the lowest risk. And for me, as an advisor, and being experienced, not being a comparison website, I can now tell you that is the lowest risk and you should be looking at other areas. So you should be looking at critical illness, serious illness, as we term it for clients, or being unable to work short term. Again, income protection in our speak, but because this is client facing, we terminology is slightly different. So if you click forward for me, Sarah, and we're going to start cantering through. So staying with that for the moment, and again, please, Sarah. So we talked about the risk calculator. We talked about earlier on in your journey, when you're talking to the clients, you can use it right at the start, even when you're positioning the mortgage side of things. I want to move us forward a bit to when you're starting to offer a product recommendation to a client now. Now with LV, we have lots of different products, all form part of our menu plan, our flexible protection plan. But they are just names, really, aren't they? These are just names of products. What do they actually mean to a client? So next one, please, Sarah. So what we do is we offer you another tool that you can use. Now this one is a bit further down the journey. And as I said, this one is looking more about product solution mode. And this is when you're starting to create that recommendation for your client. But if you're starting to select LV as your partner of choice, then when you're discussing protection with your client, we can move that journey along for Mr. and Mrs. Smith. Because if you use the protection matchmaker tool, and this is a tool that you would use and then obviously present it back to your clients, put in a bit more detail about Mr. and Mrs. Smith. So we're going to put in here that it is a mortgage related conversation, and actually they have some young children as well. And if we click on show results, so next one, please, Sarah. When we start going into product solution mode here using this tool, what it does, it says to you, quick reminder, first of all, Mr. and Mrs. Smith had that 57% chance they were going to need an income protection policy. So you can remind them again on that one. But also what it's going to start doing now is bringing out some of the features of the plan itself. Next one, please, Sarah. And another one again. Thank you. So it could be that one of the features you want to draw out from Mr. and Mrs. Smith is the fact that LV's income protection has parent and child cover built into it. No extra cost, it's built in. And the reason you want to draw that out is because they have children. So you want to take an income protection plan that now feels a bit more bespoke to Mr. and Mrs. Smith, because ultimately when you are arranging protection for your clients, you want them to keep that policy. You don't want them to cancel that in a couple of years' time because they feel healthy and they didn't need it. You don't want them to cancel it because they think they can get it cheaper. You want them to buy into what the product is doing for them in their circumstances. And in this case, parent and child cover, very simply, as it says on the screen, if Mr. Smith has income protection with us and their child is diagnosed with a critical illness, we are going to give Mr. Smith 6 months worth of his income protection policy as a lump sum. And what that means is for Mr. Smith, if he can't get paid from his employer because he wants to take time off to be with his child and he has to take unpaid leave, he's not making that choice between, do I pay my bills or do I actually stay at home with my poorly child? We're giving that lump sum payment. And that's not what he has to use it for. We just give him that payment as long as we have that diagnosis coming in from the child. So it just gives him that flexibility. Next one, please, Sarah. And I'm going to canter through the last few bits. So let's move to, for instance, if we talk to Mr. and Mrs. Smith about critical illness then. So from an LV perspective, life and critical illness cover, again, it reminds you on that product protection matchmaker tool, there's a 28% chance. So again, you can relive that with your clients. And now again, it starts drawing up some of the features. And I'll give you another quick example of that one. So next one, please, Sarah. And another click again, so it brings a little circle up. Thank you. So the little reminder on this one then, it's saying to you, LV's life and critical illness cover. Where this could really work then for Mr. and Mrs. Smith is we do enhanced claim payments. And we do enhanced claim payments for a number of different things. So again, at no extra cost, there's 17 conditions where we would pay up to an extra £200,000 on top of the sum assured as a payout if they were coming to claim on their critical illness plan because of one of those 17 conditions. Where would that stand out for you? And again, you can watch one of our other webinars to explain it in more detail. But a good example here is 9 of those conditions then are related to accident. So if Mr. Smith or Mrs. Smith had a job where they were driving a lot for their occupation, this is a great way of saying, I've picked you a critical illness plan here that would give you extra money on a payout if you were in an accident on the road, whether that was through a car, van, lorry, wherever they're driving for their work. And if that was to happen, that they had something seriousness from that car or van accident and claimed on their critical illness plan, the LV plan you've picked will give them an extra payment on top. Or it could be the certain conditions, and motor neuron disease is a good one, where a lot of people are very aware of that now because of the situation with Doddy Weir and other sports people as well. It could be that Mr. and Mrs. Smith have had experience of that in their own lives. And again, for motor neuron disease, if that's diagnosed at an early age, it's another reason why we're giving a bigger payment out as well. So again, all you're doing here by Protection Matchmaker, you can do this with any provider, any protection provider, you can do this yourself. We're just helping you a little bit with our tool. But I think what you're doing there, when you're talking to clients about consumer understanding, all you're doing is you're drawing out more of the features of the product that makes them think, actually, yeah, this is for me. It's almost been created for me in my circumstances, rather than just a product off the shelf. Because a product off the shelf doesn't guarantee that client's going to keep that policy and keep paying it every month. So make it feel real for them, make it feel bespoke. So we're going to come to the end on this one. So Sarah, next one, please. And then we'll click on again, because that just revisits what we just said. And again, another one, and one last one. There we are. So just to come to the end on that then, and just a bit of a recap then. I said I wanted to talk about consumer duty and how that does actually create positive change. And if we think about some of those things there, think about how you do design your service and that process that you have with your clients. Think about those outcomes. How are you getting that clear consumer understanding? How are you helping your clients pursue their financial objectives? So do get the bonnet up on your car, which is your business plan, your business. And as I said, anywhere along that journey, if LV can help you, then please do get in contact, and we're here to help as much as we possibly can throughout the journey. And that's me done. Well, thank you, Sarah.
Thank you so much, Carl. Really appreciate it. You know, I think that there is a lot to take out from that short session, and it was a short session, really. But you know, the key thing for me is, you know, what is your individual financial objective, and that's really quite important. What you said was bespoke. It was prescriptive planning. You know, really getting them to think about what they've already got in place and what the chances are of it happening to them on an individual basis, thinking about it from their perspective fully, and allowing them to make an informed choice based upon what their needs are. And you know, that's all we can ask, and it really does tie in with consumer duty, and it's a really positive message. And for those of you who haven't used the risk reality calculator, oh my gosh, please just have a look at it. It's incredible. You know, it's such a positive tool. You know, and for some brokers that even I've introduced it to them, you know, they've seen an increase in take up because the customer was able to see the chances of it happening to them. And, you know, that doesn't always resonate because, you know, people know what the financial objectives are, but, you know, they don't always think that that could be taken away from them in an instant, and they don't believe it. It may not happen to me. But, you know, the risk reality calculator looked at, you know, the stats throughout the UK. So although that's not individual, it's still, you know, quite a good milestone to have a look at. But, you know, I do think that overall it is bespoke prescriptive planning. So thanks, Carl. I'll get off my soapbox now. But I really enjoyed that session. For anybody that's got any questions, I'll make sure that Carl gets them. And if you pop them in the chat, he may even answer them himself.
I'll give it a go.
On that note, I'm now going to pass over to David, who's going to show us how to grow our business with Fluent Partners. David, if when you're ready for the slides to be turned, you just give me a nudge and I'll turn them for you. So just let me know. Thank you.
Can you hear me, Sarah? Yes.
Yes, I can hear you.
Oh, great stuff. Yeah. Apologies, I couldn't log on earlier on. I don't know what on earth happened there, but
yeah,
that's old people and technology, shouldn't mix.
Yeah.
So,
well, do you know what? You and me both.
I think I've got a few more years on you, my dear, that's for sure. My name's David Payton. Good morning, ladies and gentlemen. My name's David Payton. I'm a BDM at Fluent Partners, the intermediary bit of the Fluent Money Group. If you want to forward that on, please, we'll go. Oh, great. Purpose of this, explain a little bit about Fluent, explain how we can help you with difficult cases and how it can then benefit you. So if we move it on to next slide, please. Who are the Fluent Money Group? Obviously, yes, it encompasses Fluent Money, the original department who deal with secured loans, Fluent Mortgages, first charges, Fluent Lifetime, and most recently, Fluent Bridging. So we are now a one-stop packager for all your weird and wonderful requirements. We're the largest specialist packager in the UK. We're based up in Bolton. A bit of history, I've been with Fluent 11 years. But when I joined with 35 staff, we've now got in excess of over 550 staff encompassing those 4 departments. So moving on, the range of services, as just explained, secured loans, mortgages, lifetime and bridging. So we'll start moving on to mortgages. Why would you as a packager, you as a broker, use a packager for a mortgage inquiry? If you could move the slide forward, please, Sarah. In essence, if you're able to place a tricky case or you're not on panel with a particular lender. Now, I don't think that's going to come into fruition with TMA. What we are finding now, I went to a seminar recently where mental health was the fulcrum of attention for both your customers and, in this particular instance, for mortgage brokers. Because let's face it, it's been tough the last few years. We seemingly got over the COVID situation, and then Kamikaze Day ensued, and all hell broke loose again. So we've been through the mill a little bit, haven't we? And it's been said or it was said at this event, that brokers spend 60% of their time on 5% of their cases. Now, I don't know, I can't see if anybody's out there. When you do this on a face-to-face basis, you see brokers nodding and some saying, you know what, that's undercooking it. I spend 75, 80% of my time on the tricky cases. So we're finding that the brokers are sending us mortgage inquiries if they know it's going to be a tricky case, if they know they're going to spend ages on it, and perhaps it has to go with XYZ of a lender that they know they're going to lead them a bit of a merry dance, that kind of thing. We've in excess of 135 experienced mortgage advisors. They work on split shifts from 8 in the morning through to 8 at night, Monday to Thursday, and also they finish at 5 on a Friday, but they work Saturday mornings as well. So it's an option for to get the clients who may not be able to access their phone during normal working business hours. We charge a broker fee for mortgages. It's £9.95 on a high street case, but let's face it, a broker's never going to send us a case that's going to the Halifax, or £14.95 for anything non-high street or specialist, as it tends to be referred to nowadays. We split that 50-50 with you. So in essence, you sent us a case that's got to go with, well, I'll not name names, but XYZ of a lender. You're going to get £747.50 payable to your good selves. All commissions with Fluent are paid on the Friday of the week following completion to TMA members directly. So if we could move on, please, Sarah. Let's talk about secured loans. They are still the sector of the business that we're predominantly known for. It's a sector that's worth, pre-Kamikaze Day, it was worth 150 million. It got back to reasonable levels at the start of the year. Obviously, interest rate hikes have curtailed it a little bit, but volumes are steadily growing. The demand is absolutely there. So why would a client need a secured loan? So if we could move forward, please, Sarah, and go through the whole bullet points, because I think there's 7 of these. If you just sit through them all, and I'll just explain all bits. Thank you very much. So, oh no, go back one, sorry. So it may be that it's not best advice to offer a client a remortgage. Why would you? What I mean by that, if a client comes to you and you've done them a 3-year fixed 12 months ago, chances are you probably got that mortgage with a rate starting with a 1 or maybe a 2%. And to change that now, it's going to go to something at best, hope starting with a 5 or maybe worse than that. And if they've then got 2 years worth of early repayment charges to pay, how's that going to be best advice to try and remortgage the customer? If they've got too good a rate at present, I think that goes to the bullet point straight above. If it gets declined, that's the issue. If they get declined by, and that could be down to missed payments, which then unfortunately lead to defaults, CCJs, etc., etc. More and more customers are falling into bad credit because the last 12 months have been difficult for customers with rising energy bills, supermarket prices going up all the time, oil prices have gone up all the time, fuel, etc., etc. It's been a struggle, and now that mortgage rates have jumped alarmingly, and numerous people have coming off fixed rates to be given extortionate increases that they're struggling to place. The last bullet point absolutely falls into line with this. Much as though everybody perceives secured loans are adverse and purely for consolidation. Adverse is not the case at all. 75% of everything we write at Fluent, and we do in excess of 35% of all business within the secured loan area. 75% of what we write is prime. It's all on prime products. So it's not an adverse. That is a very much a misconception within the area. But there are numerous first charge lenders out there. If you look to remortgage somebody with a with a remortgage, and they've got outstanding credit that they want to consolidate, even though they're clearing that, certain first charge lenders will factor in that clients grown that credit before in the past. They'll put that on their I&E, and as a result, they then don't fit for affordability purposes. In the second charge market completely now, all the lenders clear the client's credit for them. So they pay all the credit off on when the loan goes through, so that they know on their I&E that the client has got their mortgage payment, has got their secured loan payment, any outstanding credit is nil, and as a result they can and they do fit for affordability purposes. I'll just give you a case in point. A broker, typical mortgage broker, male, same sort of generation as me, I'd seen my presentation numerous times. It's with another mortgage club. He'd seen my presentation on numerous occasions and always thought, no, I don't get clients that do that. That's the most common thing that a broker will ever say to me. I don't have clients like that. As it happened, this particular client had called him that week and said, Mark, I'm struggling. I've got 25 grand worth of credit card debt. It's extending every month. I'm struggling to, I'm robbing Peter to pay Paul. I don't know what on earth I'm going to do. Everything in my life's gone up. The only thing that hasn't is my mortgage. And the broker thought, oh my Lord, what can I do? He saw my pres, came up to me at the coffee break, said, is there anything we can do with this? Can we? So he gave me the basic outline. Absolutely, it would fit. Long story short, we called the customer that day, offered him our advice and recommendation, and the case completed within 7 working days. The customer ended up saving £650 a month. All right, that might not be a fortune to some people, but for this particular client, it was an absolute life changer. It got him out of what was a mess. The broker, as I said before, he got paid on the Friday of the week following completion. He was delighted. He was more delighted with the fact that he helped his customer. As a result, he emailed all his client bank and said, look, I know times are tough. I know everybody's struggling at the moment. Please do not feel embarrassed or ashamed to contact me if you need to have help, or if you want to talk it through. There may be options. This particular broker has sent us 19 cases thus far this year, 14 of which have completed, and another 3 of which are at lender, so about to complete. So as a result, all right, there were a couple that we couldn't save because their circumstances had deteriorated, etc. But it shows what can and is being done even in these difficult times. You'll probably think, how can anything complete within 7 working days? This client, both clients were employed, so income is verified day 1. Everything's done electronically, so everything's emailed to the customer, and they scan and email everything back into us. So there's no need to wait for postal applications, etc. The mortgage in this instance was with Halifax, so you don't need consent from the first charge lender. Again, far more common than not at the moment. Identification is done electronically, so the client sends us a picture of his passport page and a picture of his face, and our machinery has the capability, Lord knows how, but it can verify that the both are the same, and the ID is done electronically. But by far the biggest improvement in the secured loan market since COVID has been the reliance now on desktop valuations. So in the last 18 months, in excess of 65% of all business in the intermediary Fed market that we deal with has been done without the need to get a surveyor going to the property, which not only well, it can delay it, but it can also throw the spanner into the works. If a case fits on the desktop val, this particular client, it was 85% LTV and still fit within a desktop valuation purpose. That's how they will and are going through in such with such speed with their progress. So hopefully, in terms of loan purpose, much as though consolidation home improvements incur the vast majority of cases, a client can still get a loan for any legal purpose whatsoever. So all the weird and wonderful things that you've probably heard people like my good self say over the years, things like a deposit for a buy-to-let, extending a lease on a buy-to-let, investing money into a business, buying a business, school fees, medical bills, paying for a wedding, paying for a divorce even, or any manner of luxury purchase, be it a car, a caravan, a motorhome, etc. All of those are still loan options. Nothing has changed within the secured loan sector. Obviously, with the exception of the interest rates have gone up somewhat, but in essence, interest rates have gone up across the board with everything. So there are options there for your clients out there. So moving on, please, Sarah, if we could. Fluent Lifetime, if you could move it on again, please. Why does a client need a lifetime mortgage? By far, the most common reason is to clear an existing interest-only mortgage which has come to mature. That's still the most common source of inquiry. Lifetime, as everything else, has taken a lot of a bashing in the past 6 months because of the rising interest rates and, more importantly, the squeeze on the LTV sector. So it's an area that's struggling at this moment in time. But there are still products out there. There are still options for customers. It's always worth at least having a look, basically. All the other bullet points that stand there are still absolutely allowed, but it's becoming more and more difficult at this present moment in time to actually place cases at present. So if you could move on to the next slide, please. Fluent Bridging is the newest sector in our business, started 2 years ago. Why does a client need a bridge? So why would your customer need a bridge? If you could pull it on, push it on, please, Sarah. Oh, and go, yeah, thanks. Keep going. The one that's not showing on those is by far the most common, and it is to repair a break in a property chain. So Mr. and Mrs. Smith have found their dream home that they wish to buy, and their property is on the market. They've got a buyer, and lo and behold, the buyer pulls out for whatever reason, and they're left with a situation that they desperately still wish to purchase that dream home. That's when a bridge is the most often quoted for. Much as though buying a property at auction, etc., etc. And certainly the fourth bullet point, purchasing an uninhabitable property, that means it's unmortgageable. So the customer then needs short-term finance to carry out whatever redevelopments are needed to make it habitable. That, in essence, normally means a kitchen and a bathroom, doesn't it? We deal mainly with regulated residential bridging. That's our core product, which basically means that the customer, a bridge, the two things that are vitally important are the valuation of the property on which or properties on which the bridge is being secured against, and most importantly, the exit strategy. So going on the sale of the repair a break in the chain, if the sale of the property would in that instance be perfectly acceptable exit strategy for the bridge. But the bridge, it comes with a broker fee, it comes with a lender fee, and always has to be quoted with 12 months accrued interest. So as a result, a client gets a quote that says, say they want to borrow 200,000 with the 2 fees and 12 months added interest, probably means that they'd have to pay back 235,000 over if they kept it for 12 months. But the good thing with a bridge is, much as though the interest rate clock starts ticking when the client draws the money down, it stops ticking when the exit strategy comes into play. And if that occurs 2 months down the line, they only then pay that 2 months interest, which clearly saves them a considerable amount of money. So moving on, please. Why choose Fluent Partners? Now, there's various packages out there, and I'm sure you've come across various people and tried various people in the past. Biggest support you get from Fluent is the number of staff. That is, at the end of the day, that's a simple thing. If you've got an inquiry that you want the customer calling, the fact that we've got 550 staff means that that customer will get called at the time that you suggested. And I'll go through that in a second. The clients have access to our Fluent app. I'm sure if you've ever dealt with, or had clients that's ever dealt with Fluent, they absolutely rave about this app. It gives them push notifications and they get no updates all the time on as an updating occurs. Clearly, everybody is ridiculously reliant now on their phones. They don't want to waste time checking in or whatever. They just want ease and simplicity, and the app certainly helps them. We give you, as brokers, there is a case tracking facility. Unfortunately, it's not the app, but we have a somewhat more antiquated version of that. But you've always also got our broker support team to give you support through that. So moving on, please. If you could, oh, thank you. We've introduced a 15-minute challenge for TMA members. What we like to think, if you've got a tricky case that you sat on your desk that you're struggling to place. So if you've got, let's just have a simple scenario. Customers come to you, wants to clear 30 grand's worth of credit card issued by means of a remortgage. Their mortgage currently sits at this level. Their remortgage might take it up to here, and you're thinking, my gosh, is there a cheaper option? If you contact our broker support team, we can get you an answer with that within 15 minutes. That's the idea of the 15-minute challenge. If say that's you've got, so if you could move it forward one more, please. Thanks. If you contact, now you take nothing else away from this press, that broker support team there, 01204 472 030, that gets you through to our telephone BDM team, of which we've got eight members who 9 to 5 or 9 to 5:30, Monday through Friday. If you've got a simple, you've got a case that you're struggling with, so that the most information we'd ever need from you would be for a secured loan inquiry, and that would be, how much does the customer want to borrow, over what term, what's the property worth, what's the mortgage balance and mortgage payment, who's the lender, and what's their income. That, in essence, is enough information for us to be able then to give you an indicative idea as to whether or not a case will fit. We'll ask you what the age of the customer is, because the term of the loan doesn't need to mirror the term of the mortgage. So if for affordability purposes, it needs to go 5 years longer, for example, if that is the case, more than happy, the lenders are more than happy to do that, because the majority of secured loans are cleared within 2.5 years. It's a short-term solution. Majority of products come with no early repayment charges. So you can get a 5-year fixed rate, or a customer can get a 5-year fixed rate with no ERCs. Again, the flexibility is there. So we'll tell you then whether or not a case fits. And if then you say, that sounds great, we just need enough information to get through data protection with the customer. So name, address, date of birth, contact number, and most importantly, I think, a convenient time to call them. That then means that if you forewarn them that somebody will be calling them from an 01204 number, because everything's done from our head office and everything's done on a recorded call. So that protects everybody. If you forewarn them that somebody's going to be ringing on an 01204 number in an hour's time, that call will be made. That absolutely will be made. We call the customer, do a brief fact find, soft credit search, so there's no footprint. That determines what products are available. We'll then source the market as per their requirements, call them back, offer our advice and recommendation, and if they're happy to proceed, documents can be downloaded by the customer via the app, usually within an hour. If that happens in working hours, if it happens after 5:30, those documents are going to be able to be downloaded the following morning. That, in essence, is how simple and easy it is to utilise us. I'll just go back a couple of points. All commissions are paid to yourselves on the Friday of a week following completion. It's the 4 departments. Much as though we're on panel now with TMA for this is our 2nd year. Everything we've done seemingly at the moment is virtual. If anybody out there in the world wants me to come and have a chat with you to explain face to face about what we do and how we do it, I'm more than happy to do so. We have a couple of decent sized companies under TMA banner that use us, and they would absolutely vouch for the benefits of using our good selves. Thank you very much indeed. I do apologise again with all the issues I caused Sarah and the team in the background there with my inability to log on earlier on, but gremlins are gremlins. Thank you very much.
Thank you, David. Yeah, really brought to life the services via Fluent. You know, if anybody wants to get in contact with our mortgage help desk, then please do so, because we can pass you through to them as well. So yeah, perfect. Thank you so much. Any questions? Give me a shout and I'll make sure that they go directly through to David. So good presentation. Thanks, David.
Thank you very much. Thank you.
Thank you. Okay, so moving on to the Tipton. So we've got Andy Millard, and Andy is going to be talking to us today and showing us basically how to give our clients options. So I'm looking forward to this presentation, and I'm just going to pass straight on. Thank you.
Thank you, Sarah. Thanks, everyone. So as Sarah said, my name's Andy Millard. I'm the head of intermediaries at the Tipton and Cosley Building Society, and the presentation today, really, I'm looking at this as more of a bit of a refresh and a relaunch opportunity. I took over as head of intermediaries just over a year ago, and through a lot of hard work through the team, we've sort of reorganised how we operate, looked at where we can improve our offering, and actually our lending last year grew 40% on that of 2020. So we've got ambitions to increase that even further and grow our year-on-year lending, and we're on track to do that. We've had a really good start to the year, despite all of the challenges that are out there with product pricing and all of the other challenges that you guys are going through as well. But that tells me that we've got criteria products that brokers look to use within the challenging times that we're in. So the benefit of speaking to advisors becomes more and more apparent when we're in the environment that we're in at the moment. So hopefully I'll be able to offer you a few more solutions and options that can be utilised by yourselves when speaking with your clients. It's great that we've got 30 minutes today. I generally find that is the sweet spot for presentations before information overload kicks in. So let's get into it. So if we could go on to the next slide, please, Sarah. Our three pillars. So this is really our main approach to lending. There's three key segments of the market that we look to support in addition to those vanilla mainstream lenders. So it's first-time buyers, established. I'll bring to life what that looks like a bit later on, and then the later life lending space. We want to increase what options there are in those spaces. And we're consistently looking how we can grow our proposition through these three areas, which supports the society's corporate plan objective, which is to help members to own a home at all stages of their life. So if we go on to the next slide, I just want to, we could just move on to thank you. No, back one more. Back another one. Seems to have missed a few. Oh, there seems to be a couple of slides missing out of that one. Should be one that's typed about credit search in there.
I'll move them along, Andy, and see if we can find it, if that's
Yeah, it should be one that's got benefits of a credit
this is the
search.
slide deck that I've got. So
oh, stop there. There we go.
yeah.
Yeah, we might have to play jiggery poker as we go, but it's fine, no worries. So really, I just want you to sort of put a bit of a foundation into what it is that we do. So we don't operate a computer decision-making system. Because of that, all of our applications are manually underwritten by experienced case handlers. And they've got no regard for that credit score. So this provides us with an opportunity really to apply, I suppose, a more common sense approach to underwriting when assessing your client's application, rather than that strict automated approach adopted by so many high street lenders. We do complete a basic credit check when processing that DIP, but the benefit is that we can look to support those applications even where there may be a lack of extensive credit history. That doesn't prevent us from accepting the application. So if your client's not on the electoral roll, for example, we simply request additional proof of address as an alternative. If there's occasional late payment history in there, we can consider that, or they've got additional blips on their credit file that we won't immediately reject those. We give full consideration to them. To give you an idea of what those blips look like, missed payments we can accept up to a status 2 within the last 2 years as standard. Anything beyond 24 months, we've got no maximum statuses from that point forward. And up to 3 payday loans in the last 12 months, as long as they're being serviced, we're okay with those. If you're looking at defaults, it's a maximum of 3 defaults per application, but they can't have anything more than a combined value of £500, and they need to have been settled within 3 months, before 3 months of the application coming in. CCJs, again, 3 maximum on an application with no more than a combined value of £500, but they must have been paid 3 years prior to application. We also ignore credit agreements that are obviously to be repaid, but we also ignore those that have only got 3 months left to run on them. So as long as we've got evidence of that, then we can ignore those as well. Keep this in mind as we walk through the other slides, just to keep that in the back of your mind, because these things all sit in with what we're doing. The next slide should be one that's got the basics title on it. Sarah. That one seems to have gone for a proper walk, that one, doesn't it? Yeah, that's fine. Take it back to the areas of the market that we cover, and I'll just cover off what's on that slide. Thank you. So with regards to the basics themselves, we will offer a 40-year term up to a 25-year term for lending into retirement. We've got up to 90% LTV on offer for standard repayment loans. And then within the large loan range, we can go as standard up to 1.5 million. Anything above that, we can look at and bespoke. Earned income, we will take to age 70 or 75 as standard, just basically dependent on the sector or whether it's a manual or a non-manual role. And we can go up to age 95 with any lending into retirement. We can utilise 4 applicants' incomes. We've got a standard income multiple of 4.49. And we've actually recently carried out an exercise on our affordability calculator. It hadn't been reviewed since 2017, I think it was. And there's a lot of, how can I put it, lifestyle benefits and choices that perhaps we don't have access to so much now with regards to the cost of living. So we've stripped all of those out, and what that's done is that's actually improved the affordability. So previously, if you've looked at our affordability and thought maybe it was a little bit harsh, we're actually finding that against our peers now, we're either equal to or actually coming out a little bit more with regards to that going forward. We lend in England and Wales, and we offer product transfers to brokers as well, and pay a PROC fee on that. With regards to the areas of the market that we lend in, on the screen there, we particularly get most interest in our 100% lending, which I'll cover off in a second, joint borrower sole proprietor, CIS is another good one, interest only part and part on residential, lending into retirement, expat buy to let is another one, and we've also just ventured into shared ownership. So I'll cover off a few of those as we go through. The incomes considered titled slide, Sarah, if possible. Magic. So I'm not going to cover off all of these because they're all on there and you can read through them. I'm just going to pull out a couple which are quite poignant at the moment. So 100% of known future pay increases. So obviously a lot of people are going through that process and have had recent pay increases due to the current cost of living situation. We're quite happy with those, either with a letter or if they're due to take effect within the next 3 months and that letter confirms it. So we don't actually need to wait to see that first pay slip. So if we've got confirmation letter from the employer, that's good enough for us. Second job income as well. So we'll take 100% of this. We just want to make sure that it's sustainable. So we do require that they've got a 12-month track record of that. A great little USP that we also do have that I don't think is known enough out there is we will take 100% of UK land and property income that's declared on the SA 302. So this can really help boost affordability and particularly kicks in quite well with lending into retirement where we can take that income right up to the age of 95. Salary and dividends where an applicant holds less than 25% of a shareholding. So this is typically where we will take that their standard PAYE income, but also if they've got some dividends coming off the back of the fact they may have a 10% shareholding, we're happy with that because generally it's a situation where it's a family member or an employee who has been given a stake in the business because they've been there for a long period of time, so almost recognition of that longevity of service. Or they're going to take on some more responsibility, so we can look at that as well. We've also got great recognition for foster parers, so we just need a 12-month history, but we'll take the invoices and the pay slips for that income instead of the need for the SA 302s themselves. The other incomes will be pulled out as we go through the rest of the presentation. So the next slide is titled Good to Know. That's the one. So these are just a couple of bits that really help with our broker relationships. So our Connells relationship, who we do the majority of our valuations through, what really surprised me when I joined the Tipton was the closeness of the relationship that we have with Connells. So where there's a subject property that's got some quirks to it, we've actually got a really good relationship with them where we can refer that across and get them to have a look at it first. Now, they won't always come back and say, do you know what, generally that is something that we will be able to accept. But instead of just going subject to valuer's comments, which is often a bit of a get out of jail free phrase sometimes, they'll give a really clear steer on where the areas that the valuation may fall down on. So one I referred across recently was a set of terraced houses. The property was on the end of terrace, but it was very, very rural, and the access to the property was down 2 country lanes that were not made up. So there was a lot of questions around the length of the lane, whether they were passing places, whether it was used by agricultural vehicles and things of that nature. But they gave a really clear, detailed breakdown of what things that might be considered. They gave a broad steer on whether it would be acceptable or not, but it was a great tool for the broker to be able to go back to their customer and have that conversation as opposed to just subject to valuer's comments. That was quite a nice touch. LCOM referral. So this is our lending committee, and the lending committee is made up of our chief executive, our finance director, our risk director, and our customer service director. And these are cases that when you're discussing them with our telephone BDMs or our BDMs, and there's quite a lot of elements that are completely outside of criteria. I'm not talking grey, there are elements outside of the criteria, but actually on the face of it, the case looks like a really, really good one. We can refer that into that committee, and within typically less than 24 hours, we will get an answer back for them to say, do you know what? Yes, we will lend on that, because although it's completely outside of our criteria, it makes sense for us to do so because of the makeup of the case. The next one down is the mortgage surgery, which is very typical of what you'd have at other lenders. So head of lending and senior mortgage underwriters just getting together and talking about areas where there's a few bits of grey criteria. Again, within a few hours, we can get an answer back to you from that perspective. Our manual underwriting approach supports all of that. But one of the key things that I think is really powerful, particularly at the moment, is our BDMs having direct access to underwriters. Now, you as the broker has direct access to underwriters as well. You'll have a named underwriter and you'll have the ability to speak to them via the phone or have their email address and contact them that way. But if you're in communication with the BDM can have influence over that case as well. So it's great that we have that ability, particularly in these difficult times where things are a bit more challenging for everybody. So the next slide, I'm hoping, is one titled First Time Buyers. Magic. It's looking like it's coming together now. So the first bit I just wanted to cover off was the 100% lending. So this is what we call our Family Assist. This is a product that we've had on the shelf for a number of years now, and is being utilised more and more. But it allows a family member to provide either savings or their residential property as security to support an application. So this is becoming increasingly popular as the bank of mum and dad starts to see an ever increasing strain in its finances with, you know, prices rising and mum and dad wanting to maybe keep the security of their savings for themselves to combat that cost of living. Our Family Assist mortgage allows your client to borrow 100% of the purchase price or property value, whichever's lower. The applicant does need to be able to afford, the affordability needs to cover 100% of the property value, but they don't need to put down a deposit. The deposit comes in the form of, generally it's mum or dad, but it can be other relatives, supporting the application by adding a collateral charge of 20% onto their own property. So mum and dad need to have a minimum of 40% equity in their property, but they can then put a collateral charge of 20% on their property, either as a first or a second charge, we don't mind, as the form of deposit for that 100% mortgage that son or daughter are looking to proceed with. We do have a savings deposit option. If I'm being brutally honest, it works in the same way as the Springboard Barclays mortgage, where you put some money in a savings account to offset the deposit. But the collateral charge one is one that is becoming more and more popular because of the times that we're in. Our joint borrower sole proprietor criteria allows family members to be party of the mortgage application to support affordability, even when they don't live in the property. So we can go up to 90% LTV. Applications can be made on standard residential mortgage products, so we don't have a specialist range for our joint borrower sole proprietor. But the biggest challenge that we always hear with joint borrower sole proprietor is around the age of the eldest applicant affecting the term of the mortgage, which does often affect the affordability as well. So to combat that, we've introduced a couple of things. We've introduced and can consider split terms to help alleviate the problem where the eldest applicant is affecting the term of the mortgage. So they can have the loan over two separate terms, with one being based on the age of the child, and then the secondary part of the loan being based on the additional part of the loan that is going to be supported by mum or dad. So then the whole loan isn't affected by mum or dad's age. Another area of support that we can do is part and part on joint borrower sole proprietor. So we can introduce an element of interest only, which again will support with the affordability side of things, because with interest only, we stress as interest only, we don't stress as repayment and then do it as interest only. It is interest only across the board. So this again can help with those monthly payments. Just be mindful of the fact that as soon as you add an element of interest only into it, the LTV gets capped at 75% loan to value. An example of one of those that we've done recently, and is actually probably more frequent type of inquiry that we're getting at the moment, was around ex-partners. So one of them wanting to stay in the marital home and one moving out. A recent example we had was the ex-partner wanted to remortgage 250k on a 400k property. The client's brother-in-law was being added to the application to support the income. They wanted to do it on an interest-only basis, but because we require 200k equity up front, if you're doing pure interest only, they actually did it on part and part. So they did £50,000 on repayment, so that at the end of the mortgage term, there would be 200k equity. And then they did the other 200k on an interest-only basis. And that worked really, really well for that scenario. Other areas where our joint borrower sole proprietor proposition can be flexible is that we will consider reverse joint borrower sole proprietor, where the son or daughter supports their parents. We can go up to 75% LTV for any lending into retirement. So that could be where mum and dad are actually looking to go using retirement income. So there then becomes an additional point to just be mindful of, is that we can only do a 25-year term or go to age 95, whichever comes sooner, as soon as we start going into that retirement income space. But we can also look to support applications where the joint borrower can reside in the property. So an example of that is a new relationship that's just been formed where an applicant wants to live, they want to live together, but they both have their own properties and maybe looking to circumnavigate the 3% stamp duty. We're all okay with that. And that's another area where we have done some lending as well. Shared ownership. So we went into shared ownership probably about 5 months ago now. The sort of fundamentals of our shared ownership proposition are very similar to those that are out there. So staircasing must be available up to 100%, minimum share of 25% and a maximum share of 75% application stage. We're quite happy with section 106s as long as we're allowed to put the property back on the market, the full market value, if we need to take possession within 3 months. But the key sweet spot for us and where we see our shared ownership cases coming from is obviously we've got that manual underwriting approach, but mainly it's the credit score piece, so that thinner credit file. And then we will go up to 95% of the client's share. So that's not just on houses and flats, that's on new build houses and flats. So our sweet spot is that thin credit file, 95% share on a new build flat. That's where we see a lot of our business coming from in the shared ownership space. And the final piece to just run through on this slide is around gifted equity. So when your client is purchasing from a family member who's gifting equity, we can accept applications up to 80% LTV using the gifted equity as deposit. And this is a great option where we will lend against 100% of the discounted purchase price. We can consider the same relatives continuing to live in the property in recognition of the multi-generational living that is becoming more and more popular at the moment. The next slide, if we could move on to that one, Sarah, is hopefully that's the one. So this is our second pillar, and this is that established piece that I was talking about earlier. So these are clients that typically have already got themselves onto the property ladder. I'm going to just run through a couple of examples of where these cohorts of clients kind of sit. So the first one is holiday homes. We call them holiday homes as opposed to holiday lets because we don't operate in the holiday let market. But these are for applicants who want to have a second home. We offer it up to 75% on a pure interest only basis. We do include the running costs of the property in the affordability calculator, so it's very much a second home affordability stress situation. However, where this gives additional flexibility is as long as the applicant is going to use the property, they can also let the property out on an Airbnb basis, and we're absolutely fine with that. So this can create additional income for those applicants. So these don't need to be holiday homes in the sense of a cottage in Cornwall, something of that nature. We've done a recent case actually where the applicant lived in Bristol, but they worked in London. And they worked in London Monday through Thursday. They stayed in the property Monday through Thursday, got it ready for Airbnb letting out on a Friday through Sunday, came back up the Monday, and then stayed there Monday, Thursday, and turned it over again. So actually the property was almost generating enough payment for itself to keep it going, which worked really, really well for that particular client. Another area of the market where we're seeing more and more interest for obvious reasons, but actually, I say for obvious reasons, these tend to be still those clients that fully understand interest only in a residential space. So these aren't people that are looking to that they're in potential financial difficulty and looking to move over to interest only. These are people that are making an astute choice as to why they want to use it. But our offerings, I think, is a very strong one. We'll go up to 70% on a pure interest only basis with using sale of the mortgage property as a repayment strategy. We can go up to 75% if they're going to use another repayment strategy, such as 25% of a pension pot or something of that nature. We can also go up to 85% part and part, as long as I said earlier, the mortgage term and the combined equity on the repayment amount equal 200k at the end of the mortgage term. If it's pure interest only, there has to be 200k at the start. We don't have a minimum income requirement for our interest only, based purely on affordability. The interest only element is stressed as interest only, as I said earlier, not repayment and then done as interest only. And the term can be taken to age 70 or 75, depending on the nature of the applicant's work, whether they're working in a non-manual or a manual role. So if they've got a desk-based job, we can take up to 75 all day long, no problem at all. We do offer self-build mortgages as well through our partners at Build Loan, but that tends to be for specific brokers. So I'll mention it for awareness, but if you require more detail, then please just reach out to your BDM or TBDM and they can cover that off with you, no problem at all. So CIS workers, we're really, really supportive of those. We require just 12 months experience in the field and at least 6 months of that with their current contractor. So they can have 6 months where they've been PAYE and then they've decided to go CIS. So they've got the 12 months experience because they've got 6 months CIS and 6 months PAYE. And they just need to have been with that current contractor, as I say, for 6 months. And then we will take the last 26 weeks of their slips and we will multiply that by 2 to give us the equivalent of the 52 weeks. Now, this can put us ahead of other lenders that will look to take to 46, 48 weeks. And that can make a significant difference to the affordability. Next slide should say established clients with buy-to-let in brackets. Perfect. So where we are with buy-to-let at the moment is we don't have any of the standard products on the shelf. Reason being is that I made the decision that actually with the coverage that is required on buy-to-let at the moment with regards to the rates that we would need to price, it's just not going to work for anybody. So actually, as opposed to us put loads of effort into the standard buy-to-let space and put products on the shelf that probably no one's going to use, we've focused in another area of the market, the expat buy-to-let. But I'll run through the requirements because they're the same for both. So we offer standard limited company and expat buy-to-let mortgages. We don't have a minimum income requirement. We don't have any specific self-employed or employed criteria either. We go up to 70% LTV. Consumer buy-to-let is accepted without any affordability stress test from a residential perspective. And we're quite happy with first-time buyer, first-time landlords as well. As I said, the focus that we've got at the moment is on expat. We've got a good selection of countries in the expat space that we will accept applications from. They need to be approved by the Financial Action Task Force, so that's the FATFA list that the applicants can reside in, and that's basically just prevents them being in high risk or fraud, or countries that have higher levels of fraud potentially considered within them. We do consider joint applications where the second applicant doesn't hold a UK passport. So applicant 1 holds a UK passport, applicant 2 doesn't, but we just need to make sure we can verify them through a UK institution such as a bank, which doesn't typically cause too many problems because typically expats will be converting their residential property into that buy-to-let because they're moving abroad. So there tends to be that history there. So it doesn't tend to be a problem. We will allow clients residing in up to 50 countries. We've got an alphabetical list on our website that you can go and have a look at, but they cover things like Australia, the USA, Japan, Saudi Arabia, Qatar, etc. So there's a good stock of countries there. If we could just pop on to the next slide, which should be later life lending. We generally find in this space that most borrowers' inquiries are presented to us with RIO in mind. And as we start to discuss the case a little bit more, there's elements that fall outside of the regulatory requirements that we have to abide by with regards to RIO products. So we've often found that they tend to move the customer over onto one of our later lending into retirement products, because these fit the cases that the brokers are looking to place with us and gives them that other option that I've been talking about throughout. And because of the stumbling blocks that we see with RIO, we've tried to create our lending into retirement products that sort of resolves one of those regular hurdles that comes up. So for example, a RIO product will cap out at 60% LTV, but our lending into retirement product our later life product will go up to 75% LTV. Where you've got 2 borrowers and then the death of either borrower rule applies with a RIO application on the later life products that we have, we don't apply that if the applicant can downsize to an area within a 25-mile radius of the subject property that they're looking to mortgage at that moment in time, that has 2 bedrooms and they've got enough equity to do that. So then that puts aside the death of either borrower situation, which typically falls down because you'll have one applicant who will have maybe a final salary pension and then another applicant that's just got a state pension. And if the one with the final salary pension passes away, the one that's on the state pension can't actually afford the mortgage, and that's where a lot of the RIO cases fall down. So having this equity element as an option on our later life products solves a lot of that problem. We can use state pensions, you can use private pensions, investments, SIP pots, SAS pensions, SPVs, land and property income. There's a whole host of things we can use in that later life lending space, particularly around the SIP pot piece. If you've got any undrawn SIP pots, it's possible for us, with the support from a letter from the IFA, to actually use that even if it's not been drawn down. So, for example, if someone's looking to borrow £100,000, if they're looking to borrow enough that requires them to have a £10,000 income, they've got a £100,000 SIP pot, and they're looking for a 10-year term, then we can just carve that £100,000 SIP pot up into 10 pieces, get the verification of the IFA that they've got the ability to do that, and we can use that. So even though they're not drawing that income, it's there if they need to, and that's one that we've seen time and time again. And then finally, split terms available for clients looking to repay part of their mortgage balance. So we had a client that was aged 54 and was looking to remortgage £200,000. They wanted to do £100,000 on a repayment basis with a 15-year term. And then £100,000 on an interest-only basis for a 25-year term. So that worked for them with regards to their life planning and their budget as they went along as well. So that worked out really, really nicely for them. And then if we move into the final slide, which should be one that says "Talk to Tipton" at the top, which is a blue one, which is it's a dark blue slide. Nope, that one seems to have gone awry. But what that one basically had on it was just the contact details for the team. But the other thing I just wanted to cover off in that section as well is we do have a high income multiple product, and I'm actually in the process of repricing that product at this moment in time. So it's not on the shelf as this moment, but it should be in the next few days. We have going through the pricing process, but it's something that's not advertised on the sourcing systems. Because otherwise we would be completely inundated with applications on it because of its nature. But I know the important question you're going to ask me is what the income multiple is, so we can go up to 6 times income on that one. It's based on the outgoings and the income level of the applicant, but roughly if you want to see 5.5 times income, the applicant needs to be earning, well, the application needs to have income on there of £50,000 or more. There are other options with this product, because the tendency with it, because it goes to 6 times income, is to do the larger loan size of things. But actually, if you've got someone who's maybe on 30k and doesn't have any sort of outgoings outside of the normal ONS day-to-day expenditure, we can get to about 4.8 times income, and that stretch may be the difference for them to be able to get what they're after, as opposed to maybe being restricted at 4.5 times income. Product-wise, it's generally it's a 3-year discount and it goes up to 85% LTV. But as I said, with this one, you need to speak to your TBDM or your BDM to see if the case is going to fit or not, because it's not on the sourcing system. So you do have to remember it's there, which I appreciate. It's not ideal, but as I say, if we put it up there, we would be absolutely bowled over. It is an exclusive in the sense of I only promote it to those that engage with us. So as you're here today, that's you engaging with us. So that's why I'm kind of sharing it with you. Thank you for your time today. Sorry about the jiggery pokery with the slides. I'm not sure what went on there, but we got there in the end.
Oh, thank you, Andy. Some really good options there. You know, I can see why the Family Assist's so popular as well. Loads and loads of flexibility in so many areas. In terms of your slides, I don't know what's happened there either, but what I can say is if you want to share them directly with the marketing team, and then they can make sure that everybody, you know, has a copy of them so that they can take advantage of that engagement. So thank you so much.
Thank you. Thank you for doing the slides for me.
Oh, no worries. So I'm now going to move on to Mark, who's the National Sales Manager for Zephyr. Mark's going to do a buy-to-let market and Zephyr update for us. So Off you go, Mark. Thank you.
Thank you, Sarah. Good morning, everybody. As you can see on the first slide, which is working up to now, so touch wood. My name is Mark Rukyard. I'm one of 3 regional sort of sales managers for Zephyr Home Loans. I'm based on the south coast, despite my northern tones, and we've got, so I cover the southeast, the southwest, London South, and Wales. We've got 2 other regional managers that are based in East Anglia in the Midlands, and the guy further north in the northeast, sort of covering the sort of northeast Yorkshire and the northwest. So in addition to that, we've got a very good telephone BDM team. Them guys are available sort of 9 till 5:30. So, you know, any time of the day you should be able to sort of reach out to somebody from Zephyr and talk buy to let. So next slide, please, Sarah. So yeah, I've got the very sort of the great task of trying to break down the buy to let market at the moment. You know, the sort of segue of Andy's great presentation there about what's happening in the buy to let market at the moment. So I'm just going to give a very high level sort of overview of Zephyr itself and what we're seeing in the buy to let market, and then but also sort of welcome any questions that you guys have got. You know, I think there is the chat facility at the bottom, Q&A, and Sarah's very kindly sort of said she'll facilitate any questions we have. So any burning questions you've got, out there, just drop them onto the Q&A, and we will definitely have enough time to sort of go through them. So I'm going to try and keep this, under the 30-minute sort of window there. So who are Zephyr? It's a question that, you know, when we go to a lot of events, it's, brokers are aware of the brand, have seen us on sourcing systems, but perhaps haven't really, a knowledge of who we are. So we came to the market actually 5 years ago. We're a buy-to-let lender, non-regulated lender, so we don't do any regulated lending as such, but there is ways that we can do some certain case. I'll touch on that later on. But we're part of a global business, a company called Computershare Loan Services, which is an Australian business listed on the Australian Stock Exchange. We've got businesses in many countries. We've got just over 12,000 employees across the globe. So a huge sort of parent company in the background. But Zephyr is, clearly UK based and lending on buy-to-lets only. So it is a challenging market. There's no questions on that. The elephant in the room is clearly the rates at the moment and the affordability. But we are open for business. There is still, lending out there. There's some good opportunities, and we'll try and sort of hone in on 1 or 2 things that we're seeing at the moment. So the last bullet point at the bottom there, please register on our portal. It's very easy. You'll be in straight away. Just drop your details on there, which will sort of trigger email updates, etc. And as the market evolves and it moves very quickly, you'll be abreast of any change we've got there. So next slide, please, Sarah. So a sister company that we have is a company called the Deposit Protection Service. Now, I'm sure that you may be familiar with this company. So it was authorised in 2007 by the government, and in short, it protects tenant deposits. So when one of your customers pays a landlord a deposit, we basically hold that money in our bank account. And then in the event of a dispute at the end of the tenancy, we step in and mediate between the landlord and the client directly. So it's a free service, but as a result of that, it does sort of give us a really good insight into the sort of what's happening in the buy-to-let market, looking backwards as well as forwards. So I'm not going to break down this in great detail, but what it does show there is that 2022 has seen significant growth in rentals across all regions. London and Scotland reported the highest in terms of rent increases, just over 11% there. Now, what we did see when COVID kicked in was a sort of, a sort of exit of the big cities, sort of London, Birmingham, Manchester, Liverpool, etc., where perhaps customers were looking for a bit more of a rural setting, or where they could get more office space, working from home, etc. But we've now seen a big return into the cities, especially London, which is so, seeing a sort of a big growth. And flats, interestingly, is seeing the biggest increase of rentals at just over 9.5%. So that sort of ties in quite nicely, I guess, customers going back to work from city centres and having that sort of lifestyle there. So, but what this does do is it also allows you guys, a real insight into what's happening into the buy-to-let market. So what I would say is on our website, there's a link to the DPS rental index. So you know, go on there. They do produce like a quarterly rental index, which breaks it down in high levels. So when you're talking to your landlord customers, it gives gives them more education as to what's happening. So particularly where I am in the South Coast, we've seen a lot of customers that are landlords that are looking to diversify and buy properties in the north. Now this gives you a good insight. You can click into Yorkshire, for example. You can drill down to property types. And it gives you a bit of an understanding of what's happening in them regions, and they may be a little bit alien to customers landlords that are living in the south, but if they can see what the property types and the rentals are going on in Yorkshire as an example, then it's good information, and you can have them conversations with your landlords. And I think in fairness, the way the market seems to be going in buy-to-let is that the professional landlords are certainly the ones that are looking to sort of maybe diversify and add to the portfolio as we go forward. So I did see some research yesterday from a different company showing that in Q1 2023, up to a third of landlords are planning to cut the number of properties that they hold, and that's up from 20% in the comparable region compared to Q1 in 2022. Now, what we are seeing as a business is that we're not seeing a mass exodus of landlords. That there is obviously the amateur landlords have perhaps got one or two properties that maybe because of the tax changes and the regulation coming down the track, maybe saying it's now the time right to sort of exit the market. But we're not seeing that. We're not, bear in mind we've protected. We've looked after over 7 million deposits since 2020. Since we came to the market, but we're not seeing a real exodus of landlords in the market. So, but I think it is a moving, things are changing. It's a challenging market. So, but this insight gives you a real good grip of what's happening in the buy-to-let market. So reach out to any of the team, or just register for the DPS report, and you can get some more information there. So next slide, please, Sarah. Okay, so I'm gonna touch on, might you just click a little bit more, Sarah, I think, to sort of bring the rest of the bullet. That's it. Yeah, great. So these sort of, we're all aware, I'm sure, it's getting a lot of press and a lot of noise about the EPC regulations that are supposedly coming in 2025 for sort of for new tenancies, in 2028 for existing tenancies. This is still, this, bearing in mind the consultation started back in 2020. And there's the promise is to publish a summary by the end of the year. It's still being debated on sort of in the House of Lords, etc. It's not, I think, in my own opinion, and it's not rocket science, that this is probably not going to happen, but to the timescales that they're initially sort of brought up. But in short, the landlords are going to have to bring it is coming. I think that's given. So they're going to have to bring the properties up to an A to C rating for an EPC. Now, that in itself is going to be a big challenge, and it probably sort of ties into the fact that we're seeing new build flats are at a premium, and that's a property that a lot of landlords are looking to really sort of get to extend the portfolio to buy the new build properties, because in a way they're sort of the bulletproof from the EPC changes. Now, when you look at it from a lending point of view, we've got a back book of about 25 billion. So one thing I forgot to mention was that we're part of this, the broader group, is that we do service a lot of mortgage books, and we've got about 25 billion plus of buy-to-let landlords. And for the guys that have been in the market many years, like myself, back to the iGroup days, we've got a lot of customers under different brands, Resinca, Jasper, etc., that are the old Mortgage Express, the old Northern Rock mortgages. So we've got, we're one lender that has got probably 2/3 of our book is with an EPC of D or below. And that is not out of sync with a lot of, when you think back to the 1930s, the Victorian houses, etc. There's a lot of properties on there that are going to have sort of not as yet up to the required A to C rating. So I'm not going to spend much more time on that. There's challenges there for lenders, but it prompts good conversations if you're not already having them with your landlord customers now, to say, to revisit them, pick up the phone, speak to them in terms of what's coming down the track, because there is exemptions, but it's a few £1,000 for the customers to get them properties up to the required EPC rating. So probably now is a good time to having them conversations. So next slide, please, Sarah. Just click a little bit more on Sarah, I think, because it might just bring a couple of bullet points up. Yeah, okay. So I think A couple more, Sarah, please, so it brings them all up. Thank you. So what I'll do, I'm just going to sort of pick out a few things. I'm not going to go into a criteria dump here because, you know, there's no need to. You can see the information, you can pick up the phone, speak to us. But, you know, following on from Andy's theme there, you know, what struck it for me was that, you know, the flexibility. And certainly in the sort of specialist space, there's not everything is black and white. You know, there's a lot of conversations that we have every day, and there's a lot of grey areas in specialist lending. So I would always suggest that you pick up the phone and speak to the telephone BDM team, the regional managers. We do a credit search, we don't do a credit score. So, you know, a lot of information, you know, a lot of cases that if it doesn't quite fit in certain areas, we can go into an exception and we can speak to the underwriters, we can speak to the head of risk, we can escalate them case inquiries through, because that's what we do on a daily basis. But I would also sort of, you know, champion the TMA team, because, you know, they've got a great support team there with Elle, Heather, Alison, etc., and the guys. You know, they've got a really good understanding of what's happening in the specialist world and different lenders to approach and know where the flexibility is. So, but just reach out to any of the teams and sort cases through. When I think back to sort of, you know, for 2017, 2018, you know, let's get the elephant out of the room now. It's clearly rates and affordability. So, but in 2017-18 was when the PRA brought the changes in, and you saw a raft of lenders bring out 5-year fixed rates, and the real reason for that is to get around the affordability. So, you know, because it was stressed at pay rate, anything less than that had to be stressed at a higher rate. So 2023 is seen as a big year for redemptions. You know, and that in itself gives opportunities. You know, that obviously a lot of the market at the moment is product transfers, but, you know, there is still a lot of remortgage opportunities in there. And, you know, I was having a conversation with a broker yesterday where it is exactly that. You know, they've come off a 5-year fixed rate, it's a multi-unit freehold block. The rental on that property was £3,500 a month. But the customer's gone into an SVR with the lender of sort of 9% or something, and, you know, it was quite a really high rate. Now the affordability works for that customer. Therefore, have a 5-year fixed rates, and they have a lifetime tracker. Now the difference in that is that the 5-year fixed rate, you know, clearly locks you in for 5 years as such of an ERC, but the lifetime tracker we've got doesn't have any ERC. So speaking through with a broker yesterday, you know, it fit on the affordability on the lifetime tracker. And it was a really good option for the customer because, you know, we can't get the crystal ball out, but, you know, the idea is that the rates are going to come down at some stage. So let's fast forward 12 months. This customer takes the lifetime tracker with no ERC. In 12 months' time, when the market looks different, then they can refinance back to a rate which is probably going to be more sustainable for the customer going forward. But, you know, that they have the flexibility because they have the income and it works on the affordability. So again, on that point, we have a really good affordability calculator. So, you know, again, it's, you know, quite intuitive. Put a few details in there and it'll return what loan Zephyr can do. So there is options there, you know, definitely. So what does Zephyr do? You know, getting onto this sort of criteria part is that we lend on your sort of standard houses and flats. Now, you know, on the flats in particular, there's no restriction on the height. You'll see a lot of lenders that you deal with that if they've got a flat on the 30th floor, for example, they're not as keen on that. So we have no real restriction other than that. If it's over 4 floors, the block needs to have a lift. So and we can lend up to 75% on them as well. So the houses and flats are our standard range. We then are moving to the more specialist range, which is your HMOs and your multi-unit freehold blocks. HMOs will lend on 6 bedrooms and 6 units on your multi-unit freehold blocks. So staying, you know, with the HMOs in particular, you know, the licensing requirements, if it's 3 or more occupants from more than one household, it may need an HMO license. Certain areas, it's always worth checking with the council. You know, where I am in sort of on the south coast, there's the Portsmouth Council, for example. I know that, you know, for example, you've got a 4-bedroom house and you've got 4 individuals in there, then they don't necessarily need a HMO license. So, you know, it's well worth checking. If that is the case, then Zephyr could lend on a standard product, so it's a lower valuation cost, and you don't have the requirements needed from regulation on HMO. So we have got flex on that. Flats above commercial, you know, again, we've got the tie-up with the valuers. So, you know, I'd always suggest that if you've got a flat above commercial, get the link across to the regional manager or the telephone guys. we can escalate that to the valuers and say, look, we've got this one. What do we think of that before it gets sort of booked on the ground and the valuer goes out? So, but they're quite subjective. I think what I would say is that any old Victorian flats, the new build flats tend to be more in favour with valuers because there tends to be more sort of soundproofing and smell proof, if that's a word, with what the commercial properties underneath. So local authority and deck access, again, we lend on them properties up to 75%, as well as your new build. From a criteria point of view, we lend to individuals and also limited companies. I'm going to touch on limited companies a little bit because that's probably the bulk of what we do. Probably 70% of the business at Zephyr Right is on limited company applications. I'll spend a few more minutes on that one. A couple of bullets in there. We have no minimum income. So from Zephyr's point of view, we have no minimum income as such. So we would see if it's employed, we want 6 months employed from a pay slip. Self-employed, we want 12 months SC 302. Retired income is just a pension statement. Or if they're a full-time landlord, so there is a bit of a disclaimer there. If they're a full-time landlord, we like to see 25 grand minimum gross income. So that can be driven by rental as well. So, you're never going to see, you would like to think that a professional landlord has got more than 25 grand rent going through the property business. We also do top slicing. So if it doesn't quite work on the affordability, we've got the ability in scenarios to top slice. Again, the calculator will sort of guide you through that. It needs to trigger a certain amount on the ICR, and then we can use the top slice and support that. We can lend up to 4 applicants. We don't do any first-time buyer, first-time landlords, but we can do first-time landlords. If you've got, for example, mum and dad, and then you've got son and daughter, we can accept son and daughter on the application as long as one of the applicants has owned either a residential or a buy-to-let property in the last 12 months. Age is pretty good. We can lend up to age 95 at the end of the mortgage term. For example, if you've got some more retired customers coming to the end of the mortgage term with a high street, don't necessarily want to sort of sell the property because it's on interest only, and that what they do when they're 70, 75 years of age. We can take them customers up to 95 at the end of the mortgage term. So again, there's another option there for your customers if they want to sort of keep that rental income and don't necessarily want to sort of, dispose of that property from the portfolio. Unlimited portfolios, we have a customer who's got 400 properties. So in the background, so we haven't lent on all of them, don't get me wrong, but Zephyr will lend. There's no restriction on how many properties the customer can have in the background. That doesn't influence what we can do at the front end. So it's a very high level in there in terms of what Zephyr can do. So broadly speaking, we can lend across a whole range of property types, from your standard box standard houses and flats into the more specialist types, and obviously to individuals or limited companies. So next slide, please, Sarah. Yeah, so this is something that sort of triggered from a case that I had last year, actually. Now, this was a customer that had a lot of properties in a partnership, and wanted to sort of incorporate them properties. So there was 58 properties in total, and the loan size was £13 million. Now, what we did, we worked with the broker on this at all stages of the application. So the dedicated underwriter, we had direct access to the head of risk, we had the conveyancer, who was very good and understood limited companies. This was a limited company transaction. And we worked right the way through with the broker, and the cases got offered in 3 weeks. Now, for a lender to offer 58 properties to the same applicant in 3 weeks, was really sort of driven by this bespoke service. Now, in this particular client, it was a partnership incorporation. So the next slide, please, Sarah. Yeah, so the customer I was going to try and sort of pick the bones out of this one, but it was 58 properties. Now, they were in a formal partnership with a husband and wife. Now, it's becoming more and more common this when you look at, I'm sure you've all got large, because you've got portfolio customers in there that are, looking to move into limited companies. Now, obviously the caveat on that is, the limited companies is a growing part of the market. you know, we're not going to sort of go into the ins and outs of the benefits there, but, you know, I'd always encourage that customers have conversations with tax advisors, accountants. Now, this particular case, to take it from partnership into a limited company, the HMRC rules around that are that the customers need to complete on the same day or very much within 24 hours. Now, for the brokers to try and get 58 cases with several lenders to complete on the same day was almost impossible. So he needed a lender that could look at the portfolio in its total and work with that size of transaction. And that's what we did. You know, we worked in there, and we got, and there was a lot of stuff in there which was probably outside of criteria in black and white. And for example, a lot of the properties on the same street in London. Now, you know, lenders do have exposure limits. Now, to try and lend to, you know, a lot of properties on the same road was probably out of sync with what definitely is for us. But, you know, the head of risk went down, met the customer, looked at the properties, said that's not a risk. It was 60% LTV. So we ticked that one off quite quickly. So the key thing there is that, you know, there's a lot of flexibility in there. So I think we just need to, if you've got large customers with portfolios, and the biggest takeaway for me from Zephyr is the biggest USP we have, which stands as, you know, aside from many lenders in the market, is that we have no stress on background portfolios. So all we're interested in really is the properties that are coming to Zephyr. So if you work that through, you know, that customer with 400 properties that I mentioned earlier, you know, we've done a few of them properties at this stage. Now, we stress test the properties that are coming to Zephyr, but the other ones in the background, as long as the overall rent covers any mortgage payments, that passes. So, you know, it's a real challenge in the market, is affordability. Now, when lenders start looking at stress testing back books, it becomes, you know, even more difficult to get the cases approved. So the biggest one for us, if you've got portfolio landlords out there, Zephyr will stress test the properties that are coming to us. But anything else in the background, you can see the spreadsheet, you can see the rental, you can see the mortgage payments. If the rental exceeds the mortgage payments, that passes affordability. So you've got real surety there that, you know, Zephyr can lend to that particular landlord. Next slide, please, Sarah. So looking, I don't think there is any questions. You know, I'm quite surprised, but, you know, if there's anything out there, just I've sort of gone through things a little quickly. If you want a bit more clarity, just drop it in the Q&A. But what I would say is that, you know, Zephyr, you know, it is a tough market. I won't state the obvious, you know, you know, we're probably more exposed than most because we don't have the residential, you know, diversity in our product range. So, but we are lending, you know, that's the key thing. You know, we're there. You know, there is still customers that are looking to purchase business that still fit affordability. You've got a whole raft of mortgages that are coming off the 5-year fixed rates this year. Great opportunities there to speak to them landlords. It may well be a product transfer that is best for them, but if they're looking to raise additional monies, or indeed grow the portfolios, and I think that's where the market is clearly going. You've got your professional landlords that have, you know, got decent sized portfolios. They're quite lowly geared. They've got, you know, enough equity in there. They can ride it. You know, it's a long-term investment. You know, it's not a sort of in it to sort of make some quick money. It's a long-term business investment. And I think that's where the opportunity still exists. You know, we're seeing a real diversity. You know, HMOs, multi-units. You know, even commercial units, flats with commercial, etc., where perhaps there's more yield there. Or even it could be customers moving out of their own area. You know, it is hard to get affordability in the southeast, especially. So, you know, when I look at properties in Hull, or drop the H, as a true Hull lad would say, you know, you can still get good properties up there with a great yield. You know, you might not get the capital growth, but you'll certainly get the yield, and it'll work on affordability. So. I want to thank you so much for, if there isn't any questions, I think I'm just ahead of time, which is great. But thank you, TMA, for the opportunity, and more importantly, thank you guys for dialing in. I'm hoping that there's some takeaways there, but, you know, let's just register, pick up the phone, speak to us, and start to sort of get on board with Zephyr as we go forward. So thank you.
Yeah, thanks, Mark. Again, there's like loads of options in there, loads of flexibility. I think the key message is just to communicate, you know, call Zephyr and find out, speak to them, see what they can do. That rent index is quite interesting as well, gosh, 44.51%. of someone's earnings in London is the rent, and I find that you know, quite a lot really, and I'm guessing that's on gross earnings as well, which doesn't leave
Yeah,
me
I think
a deal.
it was about 33% of sort of over the UK, Sarah, is rental, and you know, and that's continuing to rise, isn't it? And that's partly driven, I think, by, well, not by a thing, but by the cost of living increases and importantly the increased cost for landlords. So you know, that's being passed on somewhere.
Yeah, definitely. That's screaming out to me. Income protection as well for you know, for renters, something that everybody needs to be you know, having in the forefront of the mind. Great presentation. Thank you, Mark.
Thank you, Sarah. Thank you.
Appreciate it. So we're now moving on to our consumer duty topics. So we've got Sue Ramsdale, who's our compliance and technical support manager. And Sue's going to be supported by our guest speaker, none other than Roger Holmes, who is one of our area compliance managers and does a great job for our brokers. Many of you will probably know Roger already. So what we're going to do is we're going to go through Sue's slides where she's going to give some top tips. She's going to wrap things up at the end in terms of some key points that you need to have in the forefront of your mind. And then if we've got time, I'm going to be running through some questions that we've been asked as well. So I'm going to be posing those questions to yourself, Roger, and also to Sue. And then we should get finished for about 12:30 because we are on track currently. So let's see how we go. So I'm now going to pass over to yourself, Sue, if that's okay.
Lovely, thanks very much, Sarah. Welcome, Roger, and thanks for making the time to join me today. Before we start, probably just a reminder, good or not, there's just under 4 weeks to go until the 31st of July. I think it's very safe to say that not every firm is in the same position, but don't forget, consumer duty doesn't stop on the 31st of July. Some firms are still going to have things to do, and I'm sure that there's going to be further guidance issued by the FCA in due course. So perhaps one of the good things for firms to do at the moment would be, you know, check your implementation plan, look at what you've still got to do, and if you're not going to get it all done in time, perhaps make a note of when you will be. Make sure that you've thought about the main customer touch points and that you've covered those if you can, but keep a record of where you are and perhaps more importantly, evidence what you've thought about and what you still need to do. So over to the slide then, just something I think that probably applies to all firms, whether or not you're a sole trader, a small business or a slightly larger firm. First of all, culture. Don't forget about any admin staff that you've got. Your leadership still applies to them. They also need to be trained and understand what consumer duty is all about. And then a quick reminder also, there at the bottom of the slide, where you've got incentives or rewards for brokers or advisors or any staff, don't reward them for poor customer service, and obviously make sure you include qualitative measures in any remuneration scheme that you've got. Next slide, please, Sarah. And I just wanted to take a few minutes today on something that we've not really discussed before, because I just wanted to highlight that as well as all the processes that we've talked about for fair value, the sales process or the advice process that we've talked about a lot over the last few weeks, training and competence is also part of consumer duty. So we've got advisor knowledge, advisor behaviours, and of course, hopefully everyone's going to get feedback from customers, which, and I think that's very, very important. But perhaps one of the things that stands out there for me is the concentration on advisor behaviours, which leads me nicely into the next slide, if you please, Sarah. Rule 2, a firm must avoid foreseeable harm to retail customers. I think this is particularly relevant to behaviours. The FCA say that they expect firms not to seek to exploit customers because of behavioural biases, which can be by the advisor or even the customer, or the customer's lack of knowledge or characteristics of vulnerability. Now, I'm no expert on behavioural bias, but it is something that I don't think should be ignored. So what is behavioural bias? Well, it's an action or a behaviour that influences a decision. And there's quite a few forms of behavioural bias, but the 3 points that I want to concentrate on today are conscious bias, which is where someone makes a decision about whether or not something is good or bad. They've made a decision about whether or not something is good or bad, but perhaps that's because of the way that it's being presented to them. And then we've got subconscious bias, which perhaps, I think the easiest way to explain it for me is you're putting your client at ease, but in doing so, it might not produce the right outcome. And then the third thing that I want to touch on will be framing, which is where something is presented in such a way, a bit like the previous comment I made, that the customer feels comfortable and therefore is perhaps directed to the outcome because of what's being said. So next slide, please, Sarah. So I'll give you a few minutes to look at what it says here. But if we look at the top comment that I've got there, perhaps saying most of my clients pay around £50 a month for their policy or whatever they pay could be potentially damaging to the best outcome for your client and their needs. For example, what do they need to know, or why do they need to know what other clients pay? It's relevant to them. And not all customers are going to be in the same position as the one that's sitting in front of you or the one you're talking to. Another example of that is also using the phrase, oh, it's only XX pounds per month when you're trying to conclude the transaction. And that's a good example of framing. The question for me is whether or not a customer is going to be influenced by the information that you give them. And the FCA talks about individual customers being treated in relation to their individual needs. So they're offered products that meet their budget, their requirements, and their needs. And the next slide, please, Sarah. So some examples of conscious bias. Most of my clients opt for a 2-year mortgage product. Everyone should have fracture cover, or everybody I know has home emergency. If any of these are used in a presentation to a customer, the customer could feel influenced by what everybody else has got, or in some of those statements, has the decision already been made by the advisor on behalf of the customer, i.e. everybody should have fracture cover. Again, why does a customer need to know what everybody else does or needs or wants? So perhaps the alternative, as mentioned before, is that questions are asked about the customer's views and preferences on PAP or, for example, future interest rates. And then the conversation develops further about what the customer wants, what they think. And once you've ascertained that, sense check it as an advisor. Are they starting from the right viewpoint? I think everything that customers think they understand needs to be sense checked, and for me that's a main thing under consumer duty. Another way to look at some of those phrases there, as I said earlier, was who's decided that everybody should have fracture cover or home emergency? Those are add-on products. So for me, the explanation should be given, and then the customer made aware that they're optional, and there's also obviously an additional cost. Next slide, please, Sarah. Subconscious bias. I think we're all probably guilty of that. I think some of the phrasing that's used is, oh, I'm glad you chose that because most of my clients would choose that. But again, what if it's not going to produce the right outcome for that particular customer? It's all about how you present the options to the customer and then check their understanding. Are they making their decisions based on correct information? And then don't be afraid to challenge a customer. If you, knowing all that you do, think that they're not selecting the right product, recheck why they, or ask them why they're making that particular decision. The reasons for their decision should be supported by the fact that they understand what they're getting, why they're getting it, and how it's going to benefit them. And I think that there's some of the main things to think about when you're talking to customers, whether or not you've got other brokers within your firm. Talk about things, think about things. It's not saying anything's right or wrong, but what it is doing is perhaps saying, think about how you interact with customers in a different way.
So,
Roger, yeah, go on. I was going to say, have you got anything to add?
Yeah, it was just so, like, in essence, especially from a buyer's point of view, if I'm thinking about it from almost like a sales process, you know, there's a lot of stuff that historically within the industry we've been used to saying, and the framing aspect and things like that, and quite often, like, trying to establish a budget up front, that used to be like a commonplace. But looking at this, is it fair to say actually you probably don't want to be trying to establish a budget too far in advance of the process, because then that would probably lead to bias?
Yeah, I think, you know, there's a bit of a different way to look at it. Find out all the information first. You know, that's what fact finding is all about. Ask them if they've got a budget, but perhaps don't press them into giving you something so specific. If you then explain all the risks that they can face, and I think earlier we saw the LV calculator, which I've not looked at it, so I'm not promoting it necessarily. But once you explain all the risks associated with either the mortgage or family protection or just protecting their income, the customer then should understand the risks. If you then indicate what that's going to cost them, it may be that they change their decision. So it's a full and frank conversation. I think that's what you were saying, was it, Roger? And
yeah, I was just sort of thinking about it, and it's you know, there's so many sort of historic examples, and it's about viewing it from I suppose you know, the customer's eyes point of view, that informed choice scenario, rather than a sales technique to get somebody into a right frame of mind. So it's a bit of a subtle shift, I think, but it will probably take a little time to take a step back and think about how we approach things.
Yeah, and I think there'll be more guidance coming on that. Sorry, Sarah.
Yeah, I was just going to say, in terms of budget, I don't think it's wrong to ask what the budget is, but it's like what you say, the sales techniques that have been used previously around lifting the budget may well need to kind of be reviewed to make sure that it's driving the right outcome for the customer.
Exactly. Yeah, I like that point particularly. So next slide, please, Sarah, if you don't mind. How are we doing for time?
Yeah, we're okay. We're good.
Yeah,
we're on 12:11.
Well. Okay, so I'm sure most of you do it as routine. Don't forget about supporting customers through the application process, whether or not that's risk or protection or general insurance, through to risk or the completion process. So a couple of things that I've sort of thought about recently for mortgage customers, always point out the date the offer expires. Make sure the customer tells you in a timely manner if their completion date is going to be delayed. You know, we've seen examples in the past where rates change quickly. What happens if the lender won't extend the offer and it's right at the last minute? That's an example of foreseeable harm. So just those little small conversations and next steps can really help. And the other thing is, I think we've had a question in on this recently as well, haven't we, Roger? If a protection product carries a medical exclusion, one thing for you to ask yourselves as the broker is, does it still remain suitable for the customer? Is there a loading on the premium? Is it still affordable? Or does the exclusion mean that actually the customer's hardly going to be able to make a claim when they need to, right at that point? Consumer duty just needs to be at the heart of your business all the way through. And I think what we've got coming up next, if I think next slide, Sarah, is some of the points that myself and Roger were asked about top tips for us. So rather than duplicate them, I think we've sort of split them between us. So if I go first with products and services, first of all, for me, it's important that you check your target market, have it written down for each of the areas in which you provide advice. Think about specific groups of customers that might appear in each one. Think about whether or not any of them are potentially vulnerable, and whether or not that means they've got less knowledge or they don't understand as easily as some other customers. Then consider the fair value assessments from each of the lenders and providers you use. Check that their target markets match. If they don't, note what action you take. So in other words, is that sort of, oops, I can't recommend that product for a while until they change it? Or are you actually going to just make sure that when you are recommending that product, you are extra careful about the type of client and their understanding of the product and whether or not they're able to utilize that product correctly? If you charge a fee, what value do you add to the service, and is your fee fair for what you provide? And don't forget, finally, fair value assessments need to be done annually or sooner if there are significant changes to the product or your service or your fee. So they're my top tips in terms of products and services. Roger, I think it's probably fair that they hear from you as well, so I'll give you the next two if you don't mind.
Okay, no problem. So yeah, I mean, consumer understanding. So you need to be thinking about reviewing your communications, and that's quite simply trying to remove jargon. As an industry, we're notorious for lots of jargon. But it's about making it clear, not just from a verbal point of view, but also that all your written communication when you're interacting with your clients. You need to think about as well, how do you know that the clients really understand explanations? So within your process, are you going to be asking them specific questions just to check their understanding as parts of it, such as, do they really know exactly how much they're going to pay for something, whether or not it's going to increase? Some of the key bits of information around the products that you may have covered off with them. And then also the support side of things in the respect of what comes next within the process. Every time you're interacting with a client, you should be just making sure that they're aware about what comes next, because it's just about giving that sort of information and just layering all that information so they have a real good knowledge and understanding. From a consumer support side of things, contact timing. So what you need to think about is the level of service should be as good for the client, sort of pre and post sale. There shouldn't be a differentiation between the two. From a complaint aspect, make sure that obviously you acknowledge them immediately, whether or not it's a simplified complaint that you might be dealing with, or it's a more formal nature. And then looking at things like protection claims. So obviously, if there's a protection claim going on, fair to say that the clients might be vulnerable because of that. Actually, are you going to be assisting the customers in order to sort of get the right outcome for like a protection policy? And I suppose linked in with protection as well, trusts, they can be quite sort of complex for a customer. If you've advised about trust, are they going to need a bit of additional help and support to make sure that they've got the right information, so it then becomes like a valid document moving forward? So those are sort of like key things, I suppose, from my point of view within those couple of sections. So
Thanks, Roger. Yeah, I agree with you on all of those. I think, as I said at the beginning, the FCA will start to issue what they've noted as good practice. You know, we're not saying we've got it right. We've had a good think about it. We've spent a lot of time on it, and other people may have different views as well. But I believe we've got some questions in the chat, which is nice. I don't know if you want to take this, Roger. Customer understanding. If you ask a client whether they need anything clarifying or want to go through it again, if that is documented with all the contacts, would that be sufficient?
That's a bit of a tough one, I suppose. If it's like a bespoke, what you don't want it to be is to come across as though it's like a templated tick box. And that's something that you need to be careful of. I think if the regulator was looking at a file or something and it felt as though there was no personalization around the interaction, that would probably cause them some concern. I think it's certainly something is definitely better than nothing, to demonstrate that as part of the process you try and find that in. I wouldn't put my neck on the line and say it would be a definitive, yeah, that's the way to go. But it's certainly a step in the right direction. I know that's a bit of a woolly answer. I don't know if you think any differently on that, Sue.
Yeah, I've said a couple of times in the past, for me, it's about asking individual questions to ensure you've got customer understanding. So it's customers can say they understand, but do they? So perhaps asking them to repeat things back, such as, what are you going to pay? When are you going to pay it? When can you make a claim on an insurance or protection product? What do you think you can claim for, and what don't you think, or when do you think you might not be able to make a claim? That's a good one for genuine insurance, and also in terms of checking that the customer understands whether or not they've got life and critical illness or whatever. So a couple of questions like that, perhaps noting a couple of the customer's answers or own words in the answer, perhaps even replay them in the suitability or the recommendation letter. That for me are the small finer points. But of course, it's also, a bit of a changing process for some. And, you don't want to make your suitability letters too long either.
No.
So.
No. I've got a few other questions that have come through. Rog, can I ask you this? Do you think Consumer Duty will change the approach that lenders make to customers for product transfers, i.e. the direct approach?
I'm not sure that lenders will necessarily change their process about trying to deal with their clients directly, if I'm honest. I think ultimately, yeah, consumers, they need to know they're still getting a good value product. So I suppose the thing is to think about within a process on product transfers is, do you feel that you're sort of researching enough to have that certainty that the client's still getting a good deal? I don't, as I said, I don't see the lenders changing their sort of approach, and as long as we've positioned the fact that, you know, we've done something for the customer and they're still going to get, they're sort of making an informed decision that it's right for them. And I suppose as well, something to think about on product transfers under Consumer Duty is just the whole fee and charging aspects as well. You know, if somebody is doing something that they could have done directly with a lender in 5 minutes, and that's what you're doing, but your process currently, you're charging a client a fee, you probably just need to think about where that sits on the fair value assessment, because that could be sort of challenged. But I suppose in answer to the question, I don't see that this will change what lenders do at the moment. I think from a broker's aspect, they just need to be thinking about their process. Are they confident that the client is still, you know, well informed and still ending up with a good product or service at the end of it?
Okay, thanks, Roger. So can I ask you, please, if you don't charge fees, would you still be expected to produce a service offering?
Yes, is the short answer. I think many lenders and providers are now starting to ask for a summary of a broker's service offering or fair value assessment in relation to their service. It's part of their fair value assessment, because they need to double check all firms in the chain are providing fair value. So I would do it, I would document it, even if it's only a few lines. Okay, so what lenders offer different fees to different advisor firms and networks and mortgage clubs? Is that considered fair value? In my view, it's down to the lenders to identify what each firm does for the proc fee or the commission that they receive, and then it's down to the lender and or the insurer to decide whether or not it's fair. It goes back to the previous question, and I think brokers may find that they are asked more and more in the future to provide or detail what exact service they offer for the proc fee or the commission. So as I said, so that the providers and the lenders can check it's fair. Okay, thank you. Rog, another question here. Should signposting come into play when dealing with loadings and declined protection cases?
I think we sort of touched on this a little bit earlier around the sort of medical loadings, and I think really we need to think about if there's been a medical disclosure, about referring back to what the issue is. It's going to be more about signposting, referring that back to the GP report. I mean, I think things that we can consider about signposting if there's loadings is, is there a more specialist provider that we could look at going to that deals with sort of any sort of particular impairments, depending on what it is. We could see if there is somebody that's more generous with their proposition, but ultimately signposting around sort of loadings or declines for bits of cover, whatever other scenario we look at, we've still got to make sure that it's covered off in the demands and needs, and it's still suitable and right for the client.
Okay, thank you. So one here, So if you work in partnership with a preferred solicitor and you recommend the customer to them, who's accountable if the customer deems the solicitor does not deliver a good service?
The service being provided by the solicitor would be their responsibility. Solicitors, of course, have their own regulations, and they've also got, is it the Legal Ombudsman Service? I also think that most solicitors would inform the customer about the service they're offering them at outset, along with their fees and things like that. But it's always worth the broker mentioning where they're making a recommendation for a solicitor, that the customer has a choice as to whether or not they use another solicitor. And I suppose as long as that's clear, and if the solicitor doesn't get it right, they receive and deal with the complaint in their own way, then it shouldn't come back to the broker, is my view on that one. Okay, all right, thank you. We've only got a couple of minutes left now. So what I wanted to do was really kind of signpost everybody again to the Consumer Duty Hub on the website. Because there's a lot of support in there in terms of structure and additional information. And also this presentation is one of a number of presentations that have been done, and you know, some of them have been recorded so that you can you know, review and watch them. So you know, and if anybody has any additional questions that you may have, I know there's another question there from Alison. I don't know whether you guys want to pick that up in a second, but if anybody has any additional questions that you do want to ask, then you know, by all means get in contact with your key account manager. We will do everything to help and support you. You're not on your own, you know, and a lot of you already use us for compliance support. And for those of you who do, we can direct you straight through to somebody like Roger also. But you know, don't feel like you're on your own. Ask the questions. We really do want to help you. So I'll just quickly pass back over to the team again, just in terms of that last question, and then I'll wrap up. Is the one the concern about the advisor completing the document with the client, you know, in terms of what the firm wants to hear? I think for me, the fact that you're recording clients' own words, you know, anyone assessing files or looking at files should be able to genuinely see that answers are different. And that's why I think it's important. Anything to add on that, Roger?
No, I'd agree. I think that's the best mitigation really is using those the client words. If you're recording the client words, then it won't feel like a process type thing. It is more bespoke to that individual. I think that's in reality all you can do.
Yeah, and perhaps just one final thought on that. If the client's not understanding, re-explain until, you know, they do. And sometimes that might mean, you know, leaving it for that particular conversation and then giving them a call, you know, half an hour later and revisiting it once they've had chance to clear their head. Okay. Well, thank you so much. And I'm going to wrap up there, but just quickly before I do, a quick reminder, 9th of November for our conference at the ICC. Please save the date in your diary. It's going to be a brilliant day. We've got some great presentations, really informative information that you can go back and use. And one other thing that I wanted to just mention to you is that we went live with HSBC Life last week. So if you don't have an agency for HSBC Life and you would like one, get in contact with either myself, the marketing team, or your key account manager, and we'll support you to get something set up. We hope you found this session useful. You know, we enjoy putting these on, and you know, we do them because of you. So if you have any comments for improvement or change, then please send them in to us, because we everything that we do is with the intention of making your life a lot easier. So it's providing you with information, support and resources to get the job done. So on that note, have a brilliant day. Thank you for joining us here today. Thank you for all of our speakers, and thank you for everybody on the call. Speak to you soon. Bye-bye now. Okay, thanks again. I'm going to end the session now. Thank you.
Right, bye.
Bye.